So rule number 4 is when should I trade? Now the question could actually be two. Once we understood that we are trading too much, now the next question is, okay, I have to cut down my trade, so when should I trade? But once again, the question is not, in my opinion, when should I trade? The question is more, when should I not trade? There are some times, and we'll see which ones, in which it would be just best to step away from the computer and just let it flow. Stay away from the orders, don't click the mouse button just because you want to have an open trade. Just let it go. And now that's what we're going to talk about in this. The key of understanding when not to trade is down to the volume of the trades that are happening during a forex session. There are moments through the day, the week, the month, the year in which trading is low. There is not much trading going on, and when not much trading is going on, the liquidity is lower. Low liquidity means that the price can actually move with a smaller amount of trades going on, so the price can be manipulated. Now you probably know that when you talk about volume in Forex, it's a delicate issue. You will find a lot of literature everywhere on the internet saying how the volume cannot be really seen in Forex because there is no central exchange for it. If we're talking about stocks, there's NASDAQ, there's NYSE, New York Stock Exchange. You can actually see all the trading going on into that floor. So volume can be measured. It doesn't happen in Forex. Forex is over the counter, can be traded in 1,000, a million different places. Therefore, what you see in your indicator in the MT4, MT5, or whatever you use is not the real volume that is going on. So how's that a problem? What about the volume that I see on my MT4? Can I trust it? Well, there will be again a lot of literature about this, and you can go. There's a recent article on FX Street that I thought was interesting just about that. They actually run some comparison between whatever gets the closest to the total amount of volume going on Forex and the normal volume indicator, which is basically tick indicator. So how fast the tick moves through a pair. In the end, the results of that study are that the volume indicator that you have in your platform is not precise, but is close enough. Obviously depends on what kind of use you have, what kind of trading you do. But in the end, for an average investor like me, like you, that's good enough. Still talking about volumes though, what I think comes into play and what really can give you an idea on how the volume going on at a certain time of the day or of the week is actually given by experience. Trade for a while if you have not already, watch what's going on, see how fast the price is changing, just open the quotes page and see how much they blink, how much they go blue, red, whatever. That is an indicator of how fast tradings are occurring at that particular time. You will come through see that in some times of the day, and again of the week, of the month, of the year, those changes are not really that fast. It's almost still, same color, to the point that you're actually wondering if it's loading the page. That, in my opinion, is the kind of experience that can give you an idea on when to stay away from the market. Another consideration that I always do whenever I'm talking about volume and Forex is that traders are people. You may be a small trader doing that from home after he comes from work, could be an investor, could be a professional trader, can be anything. But they are people. They sit at a desk, they do act through a computer, they have whatever rhythm that works for them. That can explain why the volume changes in some particular manner once again throughout each cycle. Could it be a day, could it be a week, could it be a year? Let's take, for example, the days of the week throughout the trading week, which is Monday to Friday. Forex is 24 hours a day, but Monday to Friday. So what happens? You're a small investor or a big investor, doesn't matter. You sit on your desk on Monday after the market open. You're still digesting the news that came out during the weekend. Some pairs may have gap, some may have not, but in any case, I doubt that a professional trader or someone who has experience will just jump first thing and open a big trading position just based on whatever he saw on the weekend. What do we normally do? We sit there, we take a look at the news, we see how the market reacted in the first few hours, and then eventually, once we have an idea of what could be the trend for the week, then we open a position. And this is the reason why, if you actually develop some experience thinking volume, you will see that Monday usually is not a big day. There isn't much of a movement, and if it does get some movement and eventually some trend, it's often reversed in the next day or two. So Mondays are usually a low volume day. Fridays are also usually a low volume day, except on the first Friday of the month because of NFP, non-farm payrolls, so big news are coming out. Usually investors want to watch those numbers and eventually act after, or they have taken a position and they want to wait for that news to eventually close it. So usually though, Monday and Friday are low day. Tuesday, Wednesday, Thursday, that's when the trends develop. Even during the days, if you start looking at the volume, you will see that it changes in more or less periodical manner, always the same. It has some tendencies. You know that the 24 hours when Forex is traded is usually divided into 4 sessions. We have Sydney, we have Tokyo, we have London, we have New York. Throughout those sessions, there are times in which trading is high volume, and times in which trading is low. You will notice, even if your indicator once again is only related to your own platform, to your own Forex broker, you will notice that there is a peak in the center of the session. And instead the beginning and the end of the session are usually lower volume, lower average, lower compared to the average. And you will see this peak throughout all 4 sessions. There is a peculiarity, which is the Tokyo and Sydney session are quite close to each other. They're closer than the New York and the London one, for example. So the peaks that you may observe in the Tokyo session and the Australian, the Sydney sections, is actually close together to the point that sometimes, in some days, it can look like a single one. Going back to the longer time frame, now we're talking about a year. Even throughout the year, you can see some recurrent peaks and recurrent throw or bottoms. For example, if you look at the volume during vacation time, like August or Christmas or Easter, obviously some national holidays, days off, you will see that the volume is low. So that too can give you an indication on when to actually stay away. So stay clear of Forex whenever volume is low. Build some experience, think volume, read. There's a lot of literature once again on it, but more than anything, develop some experience, realize why some things happen, understand that traders are human as well, and you will understand when to actually trade and when especially not to trade, which once again, I think is much more important. Stop trading in those times and you will see that the amount of trades that you have been making will be slashed to more than half.